On Point with Craig's Investment Partners.
Right, good morning, everybody. Remember, the information provided is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All objective investments are subject to risk and none are guaranteed. So before you make any investment decisions, you should contact an investment advisor, and you can find out more about our services in that regard at our website, which is craigsip.com. Okay, I've had a lot of questions lately about the debt ceiling that you're hearing about in the US. Needs to be raised, as is the case from time to time. That's on people's minds because it's in the news, and sort of related is why are markets so calm? Why are markets not more worried about things like the debt ceiling? So I thought I would address that. It has been a period of remarkably calm share markets, particularly in the likes of the US in recent weeks. And the people that have been sort of raising that have got a point. You know, you look at all the uncertainty around, stubbornly high inflation. It's not completely clear how much further interest rates will rise. We think we've seen all the increases in the US, but it's never guaranteed. Plus, the debt ceiling seems to be dragging on. So it is a little bit unusual. We even had Janet Yellen, who used to be the Federal Reserve chairperson. She's now the Treasury Secretary in the US. We've had her come out and say that the earliest date that the US might be unable to pay its bills is the 1st of June, which is, of course, just next week. So things are looming. That's obviously a big deal. You know, the US is the world's largest economy. It's obviously its most important borrower. And you would think markets would be a little bit more on edge, but that isn't the case. In fact, the S&P 500 in the US has rallied almost 10% this year. It hit a 9-month high last week, and volatility is at the lowest levels we've seen since July 2021, which is almost 2 years ago. And it's been a similar story for other parts of the global markets and currency markets too. So you're not seeing many ups and downs out there at all. Markets are just steadily moving sideways and have been in a very tight trading range, which is a bit strange. You would expect to see a bit more ups and downs, a bit more nervousness. Now, the US actually hit its debt ceiling way back in January of this year, and since then it's been using what they call extraordinary measures to keep things going, but they are starting to run out of time. So those measures will expire at some point, and they will reach a point where they actually need to come to an agreement to sort things out, and that looks like it'll come in June. So now we're in late May. And within a month, things could start to get ugly if they aren't able to reach an agreement. They're obviously working on an agreement, but we will believe it when we see it. It does sound really ominous when you talk about things like, the US debt ceiling. Will the world's biggest economy be able to pay its bills? It sounds like a really scary concept. In fact, it's quite common for the US to have to raise its debt ceiling, so nobody should panic. Since 1917, so a little over 100 years ago, there's been a statutory limit on the dollar value of debt the US government is allowed to have, and that means they need to periodically increase it, and that's happened. They've increased total debt under every president they've had since Herbert Hoover in the 1930s, the Hoover Dam. So for nearly 100 years, they've been steadily increasing that debt limit. And that's not as bad as it sounds, because remember, the economy is growing steadily over that period too. So it's sort of like your house and your mortgage. You've got a mortgage of 100 grand, 200 grand, 700 grand, whatever it is. But over time, as the house increases in value, you can actually sustain a higher mortgage relative to the value of the house. So remember, we're just talking about the change in dollar terms. And also inflation. Inflation is obviously increasing over time as well. So, what was a big amount of money back in 1920 isn't nearly the same amount of money today. So you've got to put it in perspective. Having said that, that's not to say that the US isn't a highly indebted country. It is. Its debt levels have been rising in recent decades It has higher debt levels in terms of its total debt compared to GDP, higher debt than the likes of the UK, France, Germany, certainly New Zealand or Australia. It's not as indebted as Japan, but it does have a lot of debt, and that has increased. But that's probably a story for another time. We'd be here all day talking about that. But I guess the point that I'm making is we need to think about debt levels relative to the size of the economy rather than in dollars and cents, because the bigger you are, the more debt you can sustain in a reasonable manner. Just like $1 million mortgage is a big deal on a house that's worth 1.1 million, but $1 million mortgage on a $4 million property is, not as big a deal. And that second example doesn't reflect the same level of indebtedness, does it? Anyway, because of that, raising the debt ceiling has been a regular and frequent occurrence. In fact, they've had to increase it 78 times since 1960. So it's been common for it to go up periodically. But in recent decades, it has become an increasingly political issue, particularly when you've got a divided government, when you've got quite a close difference between the two major parties, because they often use it to try and get leverage over each other. They'll stall and they'll use it as sort of a tactic to, we won't agree to the debt ceiling going up unless we get this or we get that. So it has become sort of, a political issue. And I think that's one of the reasons markets have been more relaxed in recent weeks. The last 6 or 7 weeks, the market's just gone sideways. The debt ceiling is upon us, and people should be worrying about that, but they're not. They almost expect this brinkmanship. They expect it to be something that the politicians won't get sorted until the last minute, because that's what they've seen in the past. So that I think is one of the reasons you're seeing that relaxed nature from financial markets. However, we do need to be aware that taking things like the debt ceiling as lightly as this hasn't always paid off. We've got a few examples in recent decades where the negotiations turned pear-shaped. 1995, that was during Bill Clinton's first presidential term. Again in 2011, when Obama had not long been in office, and then again in 2013. Things were eventually resolved in all of those examples, but there was significant disruption, because if they don't get a deal done before time runs out, that's when they have to start cutting government services. Rubbish isn't getting picked up, or libraries get closed, or some of the non-essential, the less essential services just stop happening. People aren't getting paid. You have these temporary shutdowns right across the country, and it's hugely disruptive. It annoys everybody. Financial markets get very volatile. The 2011 episode was a major one. That even resulted in the US losing its AAA credit rating. So Standard & Poor's downgraded its credit rating, and it still hasn't regained that, and that affects your borrowing costs and your credibility and so forth. So lots of ramifications, and in some ways the politicians are playing with fire. People have compared that 2011 episode to today, because quite similarly, the share market just went sideways in the lead up to the deadline. Very relaxed, nothing to see here, the same as you're seeing today. Everyone was hopeful they'd reach an agreement in advance. They didn't, left it too late. US shares ended up having gone sideways for a long period, and there was a lot of calm in the market. Then they fell 18% from late July through to early October. So it was only just a little more than 2 months. They recouped those losses by February the following year, but there was still a lot of volatility over that same period. Over that similar sort of 2.5 month period, the New Zealand share market fell 6%. The Kiwi dollar fell 14%, because obviously you had this flight to quality. Investors flocked to all the safe havens, so they gave up on the New Zealand dollar, went to the US dollar. Oil prices tumbled 24%. The US 10-year Treasury yield fell from 3% to about 1.8%, which is a huge change. That's everyone flocking to the safety of treasury bonds. Ironically, you're talking about the US sort of not being able to pay its bills in a timely manner and so forth, but everyone, flocked to US treasuries because at the end of the day, that is still a safe haven asset. Gold prices surged 20% over the period. They went to over $1,900 an ounce in US dollars, and in fact, that was quite short-lived. Gold fairly quickly fell back down to earth in the weeks that followed, and it actually didn't reach that level again until we were in the middle of the pandemic in 2020. So it sort of languished for near on a decade. So all sorts of volatility ensued in 2011. And that is a bit of a warning shot for us. It's something to be very mindful of, because like back then, there's a lot of calm, markets are in good shape, things just going sideways, not much volatility, nothing that sort of, causes anyone to sort of think, there's potential volatility or trouble ahead. Things are very relaxed. But as was the case back then, if the politicians don't get things sorted, then that can change very quickly. I think there's probably a few other reasons why investors are in pretty good spirits at the moment. We've had a solid quarterly earnings season internationally, certainly in the US, and that's finished now, and it was largely better than expected, so that's good. We've also got further evidence of inflation having headed lower. The US inflation rate sitting at 5%. That's come right back from north of 9 in the middle of last year. And so we've got increasing confidence that inflation is heading in the right direction and will continue to. And it does look like the Fed, the US Central Bank, has probably increased interest rates for the last time. I suspect we've seen the last hike from them. You never know, as is the case with our Reserve Bank lately. Things can change, information can change, and the landscape can change. But most people believe that the Fed is done, and from here they will just hold firm, but the pause is upon us. So all of those things are positive short-term drivers for the share market. There's still longer-term question marks, not longer term, sort of more medium term, looking out sort of 6 months, 12 months, still talk of, a potential slowdown or recession. But in the sort of, very short term, all of those things are keeping markets in good spirits. And if the debt ceiling debate is resolved, this week, next week, the following week, without any fanfare, that could add to the positive sentiment. I think that would potentially see markets push up a little bit further, because it'd just be another risk factor that is we can cross off and don't have to worry about that again until next time. However, there isn't a lot of room for error or time. So we've just got to be mindful that, as we've seen in the past, when we've had a period of calm in the lead up, things can change quickly. That calm can quickly turn into turbulence if the politicians misjudge the situation. So always something to worry about, and never a time to be complacent. It's something we'll be keeping an eye on, and we will be monitoring it closely. All right, thanks all. We'll talk again soon.
For more insights, visit craigsip.com.